This is our Forex blog for December 28th, 2012. And like we do most days, we use our currency meter to identify which currencies are the strongest, which are the weakest, and then basically we look and focus on buying during either pullbacks or a little sideways rectangle consolidation area breakout. We buy the strongest versus the weak, or if the one that's on the top is the weakest, we sell the weakest versus the strong. The four most individual currencies that we trade as pairs is the dollar, yen, euro, and pound. Those are the most popular that pretty much everybody likes to trade. Either the dollar yen, euro yen, pound dollar, pound yen. So the real-time strength or weakness, and this shows both the direction and the intensity. This is a new FX trend intensity tool that's really amazing at that. The top one measures the 5-minute statistical trend. Underneath that I have the 30-minute statistical trend. Then I have daily, weekly, and monthly trends. And the more time frame trends that line up, the better. For instance, the euro was experiencing a pullback. The 30-minute trend shifted down last night and continued over until about 8:30. But underneath that, you can see the daily trend was still up at that point. It shifted down a little bit later. The weekly and monthly trend are very strong. So when you know all the time frame trends, in the longer time frame trends are up, after a pullback, extreme weakness, less weakness, more strength than weakness. After 7 o'clock right here, it's pretty safe to assume, because the weekly monthly trend is so strong, that the euro is going to resume its uptrend. And of course it does, and you can see about an hour and a half of pretty intense strength after that. And you can see the exact opposite pattern in the yen, and to some extent the dollar. The dollar, the monthly trend's down. It's not quite as weak as the yen. The weekly trend's up. The daily trend was mixed. But you can see as the euro is gaining strength here, the dollar had a little bit of strength earlier, and then less and less, and then some weakness showed up. So when you saw the exact opposite pattern in the euro, after a little bit of weakness right here, it's pretty safe to assume the more intense strength is going to continue, because it's in the direction of the weekly and monthly, and it does. And that's how you use this to anticipate trends. At 8 o'clock right here, it would have been a very high probability to assume the euro would resume its uptrend and the dollar would continue going down. And so you're looking for euro dollar buys coming up to and before 8 o'clock. So that's how you use this tool as a predictive tool. So it's just, this is a special layer I put on the workspace that I trade with. I want to just bring up a chart here, and we'll turn it into a range chart and show you how to use it. Put on layer 19, which is where I have this currency meter located. And again, at 8 o'clock, we're looking for a resumption of the uptrend. Now you can see on the trend, if most traders looking at this chart would say, well, this is in a very strong downtrend, which it clearly was. But at 8 o'clock, the dollar was getting weak against almost all currencies, and the euro was very likely to resume its weekly uptrend, because it was showing signs very clearly against all currencies, or it wouldn't show this. We're statistically comparing the euro to the dollar, the yen. In the past we compared it against the Swiss, but now they're pegged together. The pound, the CAD, the New Zealand, the Australian. So the euro was going up and getting stronger against all of them. And so you can see at 8 o'clock right here, there was a little bit of a pullback. You might wait for it to go above this bar right here, and you go long, and you can see a nice 20 pip move, another pullback, another continuation. Most of us trade now on range charts, so either a 5 pips per bar range chart, or what my new favorite for myself is a 3 pips per bar, just because I like to scalp and I like to trade big lot sizes, and I still occasionally catch 20, 30, 40 pip wins, but I have a ton of 6 to 12 pip wins with big lots, and it allows me to trade an hour or two every day and kind of hit my minimum goals. So here's a range chart, and what's beautiful about it is you can kind of spot pullbacks so nicely. At 8 o'clock we are looking to buy a pullback. You can wait for a trend line to get broken. You can put a displaced moving average on here. what my new favorite method is putting the trend candle code on here. And when the trend candle after 3 to 5 bar pullback goes from red to green, I buy. So in this case it would be right here, and you can see we're already anticipating buying, you know, after 8, and it was 8:14 where we'd be in this. The closing price is at 85, and I like the chandelier stop for the exit. And now again, this is a 5 pips per bar range chart. I'm using a 3 pips per bar range chart. So I'm going to convert that to 3R. We're going to scroll back and look at this at 8 o'clock, or coming up to 8 o'clock. So here's 8 o'clock. You know, this thing went sideways. I would have probably got into this trade and had a loss. What's beautiful about this on a range chart, if you're using 3 pips per bar, your risk is literally 3 pips. I usually put a pip or 2 underneath there, plus the padding. And so 5 or 6 pips is your maximum loss. So you can trade big lots with almost little stress, anxiety, and nervousness. And so here we got a pullback again. It goes green, and it also happens to have closed above the trailing stop, which is very close to this. And so we're long right here at 82. And then you can see this thing went up, and then we have a red bar right here. And a lot of times when you have wicks going up and then it closes down on the bottom, this is oftentimes the end of the move. And if I'm lucky enough to catch one of these nice 20-30 pip wins like this, I usually just exit right here because the stop is only at 14. That's 4 extra pips. But you know, if you're doing 10 lots, that's $400. So by getting out a little bit early, so it does pay to anticipate exits. You know, once you hit your minimum profit target of 15, 20 pips, whatever it is. Now, you can also use and wait for a close above the trailing stop to get in. You know, a lot of times I wait for a little bit deeper pullback than this. This one right here was about a 12, 15 pip pullback from right here, and from the high, which was at 98, it pulled back, you know, 23 pips. So that's a decent pullback to get into the very likely new trend direction. And also keep in mind that the trend before was weak. Just showing this on a previous down move, you can see that the chandelier stop is an excellent entry and exit method. Entry, kept you all the way until there. Entry, pretty much break even. Entry, small loss. Entry, small loss. Entry, you know, 8 or 10 pip win. And even if we're buying the lows, small win, nice win, huge win, nice win. I mean, it's just the 3 pips per bar I have found to be just absolutely amazing for me for scalping. Better than range, or better than tick charts, because a 50 ticks per bar tick chart can have, you know, 2 or 3 pips for every bar, or some bars during the slow times might be, you know, 12 pips wide. Every one of these bars is only 3 pips, so if you are trailing your stop underneath the previous bar or 2 bars back, your trailing stop is giving back no more than 6 pips of your profit. I like that. So let's move this out of the way and look at some other opportunities. Earlier in the day, you can see the euro, the 30-minute trend shifted down last night. And this 40 level shows trends that are likely to continue, but when it hits 80 and plus, those trends are very likely to continue. As you can see, this one did here and this one. Now, when they hit 80 in the weekly, hopefully the daily, weekly, monthly trends all in alignment, all up, it's even more likely. This one was still 70% likely to give you a continuation trade because the weekly, monthly trend was so strong. Now, that being said, let's take a look at one that was stronger than the euro earlier, and that was the pound. You know, this one has a monthly trend that's up, the daily trend's up at this point, the weekly trend's down, the 30-minute trend's down. When this went extremely strong right here, it was so strong that it actually shifted the 30-minute trend from down to up right on that bar. If you are lucky enough to catch this on the first bar at 6 o'clock right here, you can pretty much trade it immediately on the same bar. And that's why I like this new FX trend intensity. it can a lot of times allow you to get into a trend on the same exact bar you spot these, not having to wait for a pullback first and then anticipating the trend to continue. When you spot one that explodes up like this, it means the pound's going up against every currency across the board, whether it's news related or hedge funds, major institutions are just buying the pound versus every other pair. You see it right here on your immediately. And if you want to trade it against the weakest one across all time frames was the yen at that time. I would prefer the yen having had a little bit less strength and then flipping red on that same bar. This one was already weak for an hour, which means you might not have more than 5 to 30 minutes of continuation on it. If it just goes weak on the same bar, you have a good chance of having an hour-long trade and catching those 20-30 pip wins. But let's take a look at this at 6 o'clock. We're going to buy the pound yen. And remember, if you're going to take trades that have already kind of moved a little bit your way, what better chart to use it on than a 3 pips per bar range chart, because you're only going to risk 5, 6, 7 pips max if you're wrong. In a lot of cases, it's going to move somewhat your way, and you might only lose 2 pips if you're wrong. So I'm going to bring up the pound yen. And again, we're going to scroll this back to 6 o'clock a.m. And you can see right here at 6 o'clock, this currency, you got into it really early on. And where did it go? It went from 81 all the way up to the whole number. It went up 20 pips. So, but if you miss that 20 pip move here, that's fine, because the pound was extremely strong at plus 80 strength, and the yen was extremely weak at that time, so you wait for a pullback. Again, I like 3 to 5 bar pullbacks, but more specifically 12 to 15 pip pullbacks. So from the 139 level, 12 pip pullback would be right around here, 15 pips would be right around here, and it went a little bit more. It pulled back about 18 pips or so. You could wait for the first bar to go green using the trend candles to get in right here, or since the stop is just right here at 88 or so, this closing price is at 80. It's actually at 88. The stop is at 89. It's only 1 pip up. If you want to wait for it to tick up to that level, just to avoid the possibility of getting into a new downtrend a little early, you can do so. I don't mind paying 1 extra pip higher. You're in this thing at 89, and you always want to be aware of where the previous high is. This thing had been going up, kind of gradually shot up, pulled back. It might not break this high here. So if it goes up and goes sideways here, you might want to exit half your trade there, and then the other half here, there. Now, one of the reasons I wait and I prefer deeper pullbacks, because if you get into a trade on a very shallow pullback, this is only 3 bars down, and more importantly, from the high at 04 to the low, it only pulled back 10 pips. And then, if you wait for it to go up and turn green, you're in this trade here that closes at 01. It's not likely, or it's not guaranteed. There's no high probability of this exploding up another 20-30 pips. But by waiting for a deeper pullback, if you get into it, at least it has a good chance of moving up a bar or two, moving your stop to break even. Notice once this thing starts going up, the trailing stop moves up very fast. Or what you could also do is, once you're in the trade and it goes up a bar or two, move your stop to break even, or 2 or 3 pips down. But however you want to look at it, your loss is going to be small. And that allows you to have pretty much no stress. Get into the trade. If it works, awesome. If it only gives you 3 to 5 pips, who cares? If you lose, you only lose 2 or 3 pips. And that allows you to have mediocre trades that only go 5, 6, 7 pips your way eat up trades that don't work. And a lot of times the trades that don't work, you have maybe 1 or 2 pip loss or break even, and sometimes only 1 or 2 pip win. If you want to, once it goes up a bar or 2 or 3, move your stop to +1. You've made 1 pip net rather than lost or break even. So that's how we use this new tool, FX Trend Intensity, and I just created a new color strip of it, FX trend intensity color strip, which allows you to put in whatever time frame trend you want to look at. And I absolutely love it. By having that there, I can see what the 30-minute trend is, and comparing that to the very fast 5-minute trend. I mean, 5-minute trend is super, super fast. If it lines up with the 30-minute trend, and that lines up with the daily and preferably the weekly, I don't care too much about the monthly. You know, like 4 o'clock right here, the dollar's trend, 30-minute trend shifted from down to up. The daily trend also is up. The weekly trend was already up, right? So at 4 o'clock, what was one of the weaker ones? Well, it was the euro. So if you, and also, you know, the pound as well. At 4 o'clock, even better, because the pound was weak. It's starting to show a little bit of strength, but not much strength. It's likely to continue down. You could have traded around 4 o'clock. You're looking for pound dollar sells. All right. This is how you use this tool. Let's scroll back and look at it at 4 o'clock. Here's 4 o'clock. Unfortunately, there's not much of a pullback. I probably would have passed on this trade. I don't mind selling the lows, but I like to see them go sideways for 30 or 40 minutes, kind of like a rectangle pattern like this. I would have been more apt to sell this pattern than a small little pullback like this. Now this one, from the lows here around 80, 88, pulled up to 02, so that's a 14 pip pullback. That's enough for me. I usually don't sell them the first time up if they don't move, you know, my predetermined and preferred 15 pip pullback. But when you get, it goes up, pulls back, goes up, makes a slightly higher high and fails. As soon as it goes underneath these bars right here, I typically will go short. I don't need to wait for the bar to close, although I am, you know, watching it like a hawk. Sometimes I'll get out with a 2 or 3 pip loss if it doesn't go below not only these lows, but the lows of the previous swing. Once it breaks that low here, you're pretty much safe. This one came back up, but it didn't hit the trailing stop. As it starts to move back down, I'm moving my stop to break even. And you always want to use your fib targets as well. You can hit Control F or bring up the T drawing tool. Draw your fibs on the previous wave, whether the previous swing was from pretty much this little sideways consolidation down here. Is a 19 pip move. You know where your fib target is. If it stalls at the first fib target, I'm going to exit half my trade here and then my other half here. So my exit would have been somewhere in the middle, probably at 82. I would have been short this at 98 for a nice 16 pip win. You know, again, wait for a pullback. This one's not quite steep enough. If you wait for it to pull back, go up, fail to make a higher high, once it goes back down, you can kind of, especially in this case here, it's going sideways and the colored bars go red, go short. And if it can't make it down to the previous swing low, once it goes above those bars highs right here, pretty much at 87, you can get out. And this is one of those cases where you might have, you know, made a pip or two versus having a loss. Coming up to 530 right here, if you look at the tool, here's 530. It had a lot of strength. The dollar did less strength than it did before. And looking at the pound, look, extreme weakness, less weakness. 530 right here is showing a little bit of strength. So this is what you would have seen at the time at 530. The dollar has a little bit of strength. The pound has a little bit of strength. So when you're in a trade and you see them both green, you know, it can easily reverse on you. So you know in real time to probably bail on this trade and take a pip or two, or maybe a pip or two loss, no big deal, and you're out.